Hello, chart watchers, and welcome to this Wednesday, March 6th, 2019 Market Watchers Live Show with your host, Tom Bowley. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Let's take a look at what's going on in the market. We've got the Dow Jones Industrial Average under a little pressure here, challenging the lows that we saw earlier this week. Currently, the Dow down 135 points. The S&P 500 down 15, the NASDAQ down 54, and the Russell 2000 dropping down below its 20-day moving average, currently down 17. And we have seen some relative weakness in small caps this week. 10-year Treasury yield, big move to the downside. This is a little disappointing after seeing the yield up earlier this week. You can see a big drop today, down more than 3 basis points, back below that 270 level at roughly 2.69%. Volatility index once again challenging that declining 20-day moving average, trying to close back above it for the first time in 2019. XLE leading to the downside along with healthcare. These two groups you can see very weak over the last couple of days, especially the healthcare group, which had broken out on Tuesday, actually on Monday at the open, only to fall back quite a bit. It's been a rough week so far for healthcare. Walgreens Boots Alliance down more than $2 today, 3%. And you can see over the last 4 days, really weak action here. GE came out earlier today, talked about the fact that the industrial cash flow would be negative for 2019. Market didn't like it. And you can see the stock, after being up above $11 within the last 2 weeks, now all the way back down close to $9 and getting close to a key gap support area. Couple of positive earnings surprises, though, Amborella and Abercrombie and Fitch. And you can see some very strong positive reactions in both of those stocks. And we'll take a look at those in just a couple of minutes. All right. Aaron is unable to join me today and tomorrow. And, of course, we'll have Mary Ellen in on Friday to co-host. So Aaron will be back next Monday. I am going to go ahead and just jump right in to the action today. Upcoming schedule. Today, of course, we have a very special guest, and we'll get into that in just a bit. But we do have Bruce Frazier coming on tomorrow. Aaron's workshop next week. That'll be on Tuesday. And then Linda Raschke joins us next Wednesday. So a lot to look forward to in our upcoming schedule. Today's agenda. Milan Vaishnav is with us today. This is very exciting. We'll talk to him in just a couple of minutes. And then we're going to get into the 10 in 10. Our first stock will be AMRC, fairly low volume stock in the heavy equipment, heavy construction area, but stock that's been doing very well. You can take a look at that chart and see if you agree with my assessment later in the show. And then we'll wrap up today's show with blog highlights. I want to make sure that everyone is well aware of, the blog articles and many of the great authors that we have here, and a lot of the really good content if you want to follow the market. So if you're unfamiliar with the blogs, stick around. I will go through that area with you later in the show. Okay, let's go ahead and get started today. First, we had some economic news out earlier, and you can see there the employment report. And this is one I watch pretty closely because deterioration in jobs can be a very good early signal to a market downturn. But we did have the February ADP employment report come in slightly better than expected, 183,000 jobs versus the 180,000 consensus estimate. And also January ADP employment report was revised higher, quite considerably higher, 300,000 versus the 213,000 that was previously reported. And then later today, we'll get a look at the Beige Book. This is an analysis of economic conditions. Typically, it comes out a couple weeks before the Fed meets. So the market always looking at that. That will be out later this afternoon at 2 o'clock. All right, as far as the bond market reaction to what's going on, because there, like I said, there was quite a bit to try to decipher here. And you can see the bond market reaction pretty bearish. Bullish for bonds, bearish for equities as we see the yield moving back down below the 20-day. This is, in my opinion, the first big test. After breaking back up above for the first time in a long time, breaking above that 20-day moving average and actually holding it for a few days. Now we're coming back down to test it for the first time. What we don't want to see is a false breakout to the upside and to go back down to these recent lows, because as money rotates into treasuries, that's telling us that the market is defensive and not really seeing the economic strength ahead that some are forecasting. So always a warning sign. to see the 10-year Treasury yield on the move to the downside, and we're certainly getting that so far today. As far as earnings, there's still a lot of earnings coming out, especially in the retail space. And we saw Target, Kohl's, and some others report yesterday. Well, we have Brawl Stores out today matching estimates. Urban Outfitters, you can see beating. Dollar Tree. We've got American Eagle Outfitters coming out after the bell today, and some smaller ones that we'll talk about in just a minute. But overall, none of these companies that you're seeing on your screen missed on their bottom line, although some of the top line and some of the guidance is somewhat mixed, and we'll go over that here. Well, we'll go over it right now. Let's take a look first at the Brawl Stores chart, which is ROST. And when we pull this one up, you can see that we did have a 3 to 4 month breakout earlier today. Unfortunately, it hasn't held. Brawl Stores came out. They did beat on their top line, $4.11 billion. But as shown on that slide just a second ago, they only matched expectations, and they guided Q2 and fiscal year 20 earnings per share lower. So we got that false breakout, but not able to sustain it. Now the question is, can we hold the rising 20-day where we've seen buyers coming in the recent sessions, really over the past month or so. So a little bit of a squeezing here, trying to break out above 96, but also trying to hold support down near 94. COO, the Cooper companies, big breakout today earlier, but you can see a bearish engulfing candle, tail well below the 20-day, now trying to recover. A lot of indecision going on here with COO. We had a beat on the top line, $628.1 million versus $618.7 million. Bottom line, $288 versus $250. They guided their fiscal year 19 earnings per share higher, gapped up, everything looked great, and then the sellers came in. And when you look back at the chart, you can see we've had this nice run up into earnings, had a nice report, but it could be that a lot of it was already built into the price. So you get that gap up, but then there are no more buyers. Stock sells off. Now we're in this consolidation mode. Obviously, a breakout eventually above today's open at $299, I would view very bullishly. And in the near term, with a slight negative divergence, I think a pullback to test recent price support and maybe that 50-day moving average could be in the card. So I'm going to say COO is in a trading range between about 270 and 300. Urban Outfitters, URBN, missed on their top line, beat slightly on their bottom line. I didn't see guidance, but you can see the stock's been under pressure. Certainly a laggard relative to a lot of its peers. And if we pull up that relative chart, I think it will stand out. You can see that the apparel retailers bottomed in December, have been moving higher. Urban Outfitters has not been able to do the same. And so as a result, you have a relative chart with a lot of these lines moving down from left to right, and that is not what you want to see. So if you're going to be in the apparel retailers, I would suggest you look elsewhere. Urban Outfitters has been a very dismal relative performer. All right, let's take a look at Brown-Forman. This is, many of you might recognize their iconic brand, Jack Daniels. And based on the chart today, you might want to get a glass later. Not a very good chart at this point. Big drop. We missed on the top line, beat on the bottom line, and guided in line. So kind of a mixed report here on Brown-Forman. It was building to the upside. Looked like maybe we might have a nice report, and I don't think traders liked the disappointment, especially on the top line and with no raised guidance. DLTR, this is Dollar Tree, another one in that retail area. This is a specialty retailer, and the stock overall has been doing pretty well. I think it's in an uptrend, sideways consolidating. What we're looking for here is a breakout above 100. Nice beat on the top line, beat on the bottom line. What's really interesting, though, is the gap up, and then we had the selling come in. The DLTR guided Q1 earnings per share lower, and then fiscal year 20 revenues and earnings per share lower. So when you see something like that and a positive reaction, it tells me that the market is looking forward even past the disappointing guidance and looking to the fact that the specialty retailers have been a very strong part of the market. So again, what we want to see technically is a breakout above 100. DCI, this is Donaldson Company. They came out and announced big misses across the board. Missed on their top line, $703 million versus $719 million expected. missed on their bottom line, 47 cents versus 51 cents. And then they guided fiscal year 19 lower. And I think that was both top and bottom line. You can see the stock gapping down, trading down 4% on that news. All right, a couple of other stocks, and these got some pretty positive reactions. AeroVironment company came out, beat on their top line barely, easily beat bottom line, though, 35 cents versus 16 cents, and then guided fiscal year 19 earnings per share higher. Notice the volume on the chart. 1.5 million shares already. When we look back over the last several months, we haven't had any days above 1.5 million shares. Excuse me. All right. So with this breakout, I think we're breaking a downtrend. I think AVAV actually looks pretty good here. Big volume supporting this move to the upside. And again, beats across the board and raised guidance. AMBA, Amborella. This is a stock, I think if we go back and we look at a longer-term chart, we've seen some crazy moves in this stock. Ran from single digits up to 130 in 2 years, and then fell all the way back from 130 down to about $35. And you can see, actually, recently we went down a little bit below that to 30. So we've been consolidating, but if we go back now and look at this chart, this is a pretty good breakout on Amborella. We saw nice volume move higher back in early December. This is actually clearing that, and we've already done 2.5 million shares today. So definitely a lot of interest in Amborella. Beat on the top line, beat on the bottom line. Interestingly, they guided their Q1 revenues lower. All right, let's take a look at Abercrombie and Fitch. This is ANF, beat on their top line, beat on their bottom line. Mixed guidance. They guided their Q1 revenues lower, but they guided their fiscal year 20 revenues higher. So they're looking at maybe a little bit of disappointment in the near term, but they like what they see further out, and traders like the report. Beautiful volume, a really nice looking candle. I like these hollow candles where you gap up and then barely pull back at all. Think about it. When everybody's jumping in at the open, you've got market makers providing liquidity on the other side of the trade, and market makers usually make money. So when they're going opposite a gap like this and the price keeps going higher, it tells me that there's a lot of demand for the stock, and the volume certainly adds to that. So I think ANF, this is probably the most bullish candle I've seen today among all these earnings reports that we're talking about. And then finally, last one I wanted to bring up is BJ's Wholesale Club. We did get a gap up earlier, but unfortunately, I think kind of like Ross Stores, I think we looked at earlier, the gap up hasn't lasted, and now we have a bearish engulfing candle. And the question is now, can we hold the support down around $25 and start to reverse higher? One thing that I do want to mention about the retailers, and I wrote about this a little bit in my blog today. When you look at the seasonality on the XRT, which is a widely diversified retail ETF, look at the February, March, April period. It stands out really, I think, above anything else you see on this chart from a calendar year perspective, February, March, and April. And if you add up these average returns across here, this is a group, this XRT, this diversified retail ETF, has averaged going up 8.8% during these 3 months over the last 14 years. So it is definitely a group that likes this time of year, and we're seeing that reflected in some of these retailers that are reporting some solid results. So something to at least keep in mind as we go through the next month or so, month and a half into early spring. All right, I am going to bring in a friend of the show, Grayson Rose. Grayson, how you been?
I'm good. How have you been, Tom? You're flying solo today. You're just the only captain of the ship. Is it odd?
It is odd, but hey, you do what you got to do.
Yeah, you do what you got to do. I like that. Well, I'm excited to be here because I've got a. It's sort of funny that you're introducing me so that I can introduce someone else, but this is such a big deal that we wanted to do something special. I am here really just absolutely thrilled to be introducing Milan. Milan, this has been a long time coming, but for those of you who don't know, we are starting to make a big push into India. We are expanding beyond the US and Canada, which have traditionally sort of been our largest markets. For those of you who subscribe to any of our real-time data packages, you'll know that we have US and Canada, but we've also recently added UK and India. We are trying to expand the markets that we serve, and India is one of the first ones that we wanted to expand into. We just think that this is absolutely for any investors that are actually trading India stocks. They are underserved by most of the software platforms, the charting packages and everything that are out there right now. And we want to be a part of the solution to that. We think that India is just an absolutely growing market, and we're excited to serve them better. And Milan is sort of our boots on the ground over there. And he has been doing a fantastic job in the last few months, kickstarting the Analyzing India blog and focusing on bringing some commentary to stock charts that's India specific, that's focused on that market for traders and investors in Indian stocks. So Milan, we as stock charts, representing stock charts, we are just thrilled to have you. It's truly a pleasure, and we're so excited about all the stuff that you're going to be doing to help sort of bring more attention to the Indian markets and sharing your technical insights and everything like that. So I'm here today to introduce Milan, and I am absolutely thrilled to see what he has in store for us today on the show. So Milan, hopefully you're still on the line there. I know we're
yes, I'm very much on the line, Grayson.
Great.
Good afternoon, all of you. How are you all?
I'm doing great. Yeah, welcome to the show, Milan. Always a pleasure. I know Grayson's talked a lot about having you on as somebody who can communicate a lot of what's going on over in the Indian market. And so welcome to the show.
Thank you so much. It really feels great to be here. Thank you.
So we're going to let you run with it, Milan. I think you are up and you've got some time here. We're excited to see what you have in store for us. I'm going to jump off the line. I'm going to let Tom take it over. But Milan, once again, just absolutely thrilled to have you as part of the Stock Charts commentary team, and looking forward to seeing where you take things in the coming months and coming years.
Thank you so much, Grayson. So I'll begin. Good afternoon, everyone there. Just to give you a brief, it really, before I say anything about myself, I must thank all of you for inviting me here, and it really feels great to be among you all. So just before we begin, I think it would be great if I give you a brief overview of who we are and what we do. We are a independent technical research firm, and we are based in India with the name Gemstone Equity Research and Advisory Services. And we have our primary focus on the Indian markets. Our main job involves advising clients through investment and trading strategies, and conducting customized portfolio research for them. And in the process, obviously, we do provide actionable trade ideas, and along with in-depth market insights for the Indian markets. We have our technical newsletter, a daily and weekly one, which is presently in its 16th year of publication. So let me try and now come back to the purpose as to why we are here right now. Actually, I have been a user of stockcharts.com for over a couple of years now. And with regard to contributing on StockChart, it has been a couple of months that we are building up some India-focused research on the newly set up blog, Analyzing India. So this blog is set up sometime in October 2018 with the name Analyzing India. So just on the top right-hand side of the blog articles page, if you scroll down, the first blog you will find would be Analyzing India. And there we have created some good actionable content since October 2018. So if I speak with regard to the purpose of setting up this blog, we intend to create a content which is directly usable, which is directly actionable and consumable by the stockcharts.com users. On this blog, we intend to provide weekly technical outlook, technical notes on different sectors in focus from time to time, different technical, some stock specific individual stock ideas, and some which offer good investment and trading potential. So before we move ahead, I would request all of you to take note of this URL and probably bookmark that so that you can visit us again on this platform. So this is the URL, stockcharts.com/articles/India. I would again request to bookmark this for the written visit. So moving ahead, I think before we start discussing the markets and discuss different stocks and sectors that we have, let me give you a brief idea that what I'm going to talk about. We would be discussing the state of Indian markets as of today, where are all different sectors placed as of today, and what can we look in coming weeks. So at least in the next quarter. So before we move in that direction, I think it would make some sense if you all come to know our research methodology.
Hey Milan.
Yeah.
I'm sorry to interrupt, but we're still seeing the Analyzing India blog. I just want to make sure when you're ready that you share that screen, your screen.
Sorry.
No problem.
Yeah. So moving on, I think before we proceed to the market content, it would make sense if we brief the viewers with regard to the research methodology, the method that we follow while researching the charts, and through which the content ultimately gets created on the blog.
Hey, Milan, I'm sorry to interrupt again, but I'm still not seeing your screen. Just you need to make sure you click on that green share button.
You're still not seeing it. 1 minute.
No, we're still seeing the Analyzing India blog. There should be a green share button that you can click on and then share your screen, and that should bring up. There you go. That's it.
So, sorry for the interruption, brief interruption. So, starting again, I think before we move on to discuss any of the Indian charts or to discuss Indian markets, I think it would make some sense if we know the research methodology that we follow here. And following that standard process, the content that we would be putting up on the Analyzing India blog. So moving on to the research methodology, primarily we follow a top-down approach. So by saying a top-down approach, we begin deploying relative rotation graphs to identify the sectors which are rotating favorably. Once we do that, the sectors are shortlisted. And once the sectors are shortlisted, again, the components of those sectors are benchmarked against the shortlisted sectors. And finally, we create a shortlisted stocks. And while doing so, later on, we put primary reliance on relative strength, momentum, and different sentiment indicators. So now, let's move ahead and let us have a larger look at the Indian markets. I believe you all are seeing the screen wherein you're seeing two different charts. Both of these are weekly Nifty charts, but on your left is a long-term 10-year Nifty charts, and on the right is slightly the zoomed-in version, which shows the movement over last 3 years. So let us have a look at the broader structure. Let us try and understand the broader structure of the Nifty. So we are currently looking at this chart, which is a 10-year Nifty chart, weekly chart. If we see that the Nifty is primarily in a very structured, firm uptrend for over last 10 years, beginning in early 2009 and until today, that is 2019, more or less, it has been in a secular uptrend. In last 5 years, the uptrend has been so, unanimous. I would say that it was hardly 2 times that the Indian VIX, the volatility index, spiked about 20. There were only 2 instances that you can see here, sometime in 2015 and sometime in early 2016. These were the only 2 instances that VIX spiked about 20 levels. Furthermore, as can be seen here, Nifty has, except for some occasional breach for 2 times, one sometime again in 2012 and sometime here in 2016, Nifty has remained about its 200-week moving average for all these 10 years. And during this previous 10 years, RSI, as you can see here, has hardly dropped below the oversold area. It has, practically never got oversold. So we can fairly conclude that except for 1 year in 2011 and 1 year in 2015, the markets have overall been a very structured and secular uptrend. All the downsides that we see, that we saw, were within the but as of now, if we zoom in and move to the chart on the right of the screen, we see that of late certain structural breaches have occurred. So if we see from 2016 until end of 2018, markets were in a upward rising channel. That this channel lasted for around 30 to 32 months. But it was sometime in October, on the week ending 5th of October, that this upward rising channel was broken on the downside. Markets took support around, just near 10,000 mark. And it has been now flirting around the 50 DMA for over 15 weeks. So a brief conviction zone is something that the markets have created over past 14 weeks. So that is nearly just about a quarter. So in coming days, with the channel being broken, it would be very important for the Nifty to either get back inside the channel again, or at least remain comfortable above its key moving averages. Otherwise, if this 50-week moving average is breached on the downside, then we might be in for some unpleasant development on the charts. Though we are just in the middle of the week, and this bar is not yet fully complete, but we are still up 1.74% as of the session ending today on Wednesday. So, the question is, obvious question is that how should we approach the Indian markets over coming weeks? So, if we speaking broadly, Nifty's behavior against 50-week moving average will remain important over coming weeks and quarters. And as I just said, that any slip below that will invite some unpleasant formations of the chart. More importantly, as it happens every once every 5 years, even in stable political environment, we have general elections here. So general elections are sure to leave both investors and traders alike to deal with a lot of volatility. In coming year, we have elections over next 2 months. So next 2 months are going to be very volatile months for the markets. And all up moves in 2019 will require us to keep a very close eye on the market breadth. Market breadth has been suffering of late. And previous up moves, we have been seeing those up moves with a fractured breadth. So market breadth will be something that we will need to keep a very close watch on, I must say. So overall, my feeling is that the coming year, the rest of the year 2019 is going to be a very stock specific and let's put it that way, it's going to be a stock pickers year. It would be important to pick the right stock, and it won't happen. See, in India, Indian markets were in a trend over last several years. So that trend, I think we have now entered some intermediate trend. The primary trend has got interrupted sometime in the beginning of October, and the remaining the markets will now oscillate back and forth in a very broad range. So it's going to be a stock pickers market going on from here, and one will have to remain highly stock and sector specific rather than giving any blind chase to the momentum. So now that we are speaking about market breadth, I think market breadth basically gets derived from a broader index. So here we speak about CNX 500, that is Nifty 500, as it is very commonly said. Just as an overview of this index, this CNX 500 index, it represents nearly 95% of the free float market cap of all the securities listed on the National Stock Exchange. So long as this index is not performing, it is quite a matter of common sense that market breadth will not be seen. So let us have a look at this index now. Again, both the charts you see are that of CNX 500 index. The one on the facing left-hand side of the screen is the daily chart, and the one on the right, is the weekly charts. This is the weekly and this is the daily chart. Now, if we have a look at the daily chart, if you see that this index, when benchmarked, it formed a double top near 9,900 and 10,000 mark, and since then it has remained in a very sharp declining trend for the next between September and October, and it was only in end of October and beginning November that it tried to find some base. And in the meantime, we see that the RS line, when benchmarked against Nifty 50 index, has been in a multi-month downtrend. It is attempting to breach its 50 DMN and attempting to reverse its turn, but has not yet confirmed itself. As we see in this circled area, the prices today have attempted to move past the 50 DMF mark, which is 9028. It has ended a notch above that at 9230, and we might see some follow-up moves there. If we take a broader view and go to the weekly charts, the one on the right, we see that this same zone, that is 9,200 and 9,250, is where the 50-week moving average lies. Somewhere here, it may not be seen so clearly, but it has this index has been flirting with it since the end of 2018 and has not yet moved past in a convincing manner. And to the extent that this 50-week moving average has almost become a proxy trend line for the markets. We see stochastics making lower tops, but the relative strength, the RS line, when compared against Nifty, it's still falling, and it hasn't shown any kind of major reversal in the trend. or has not yet even got near to its 50-week MA, which would otherwise act as a confirmation of any change of trend. So, in nutshell, for the market breadth to improve and for us to see a wider participation, or rather any sustainable up moves in Nifty and markets in general, it would be important for this index to perform well. And for this, moving past and sustaining above its 50-week MA of around 9,205 as of today would be very important. If that happens, then we can see this index moving back somewhere near 10,000 mark again. But for that, it would require good amount of participation of the components and improvement in its relative performance as against markets in general and against Nifty in particular. So with that, we have a broader view on the markets. Now let us try and see what sectors and what stocks would be worth watching for in the coming weeks. So as I just mentioned that our chart methodology, our research methodology begins with scanning the sectors by deploying the relative rotation graph and shortlisting them. So again, we are in the middle of the week, so this final plots might vary a little, but not much. So if you it gets too much understood to plot all the sectors here. So we have I've created 3 different charts with different sectors, and all are benchmarked against the broader CNX 500 index. So here, if we see that many of the smaller indices, for example, CNX mid cap, CNX consumption, then FMCG, infrastructure, Nifty Junior, Nifty Next 50, which is called Nifty mid cap, financial services, that is CNX FIN, CNX auto to a larger extent. They are all moving southwards while being placed in different quadrants. So irrespective of where they are placed, they are all losing on the momentum front. And we don't see any major performance either by index in general or any stocks in particular in coming weeks. On the other hand, there are certain good indexes which are showing good improvement in either some new improvement in the momentum, or they are continuing ahead with nice vigor and push. So let us have a look on them first. Despite the fact that PSE, by the way, PSE is Public Sector Enterprises, the PSE index and the Pharma index, they are, despite being in the lagging quadrant, they are moving northwards very sharply, and this denotes improvement in the momentum, and we can expect some good performance from these 2 groups over coming weeks. Similar improvement in the momentum is seen in the metal pack as well. So the metal pack accompanied with Pharma and PSE are expected to now consolidate their performance in the coming weeks. Now let us have a look at what is anyway leading the markets as of now. We see that energy index is making excellent progress with very good amount of momentum. As you can see, the gap between the 2 dots, I mean, each dot denotes a week. So CNX energy is expected to lead the markets. Along with that, we see another broader index, CNX 100, also slowly crawling into the leading segment, leading quadrant. Along with that, we have IT. which is expected to do well. So, to sum up, in my opinion, the best 5 sectors that would be worth keeping an eye, which would be worth keeping an eye on, would be Nifty Energy, IT, ES Index, Pharma, and Services sector. So let us now break down our discussion from sectors to stocks. So having said this, let us try and focus on few of the stocks which would be interesting to watch for in coming days. Let us pick up with IT sector. These are the components of the IT pack, IT index, plotted on RRG with CNX IT index as its benchmark. So we see that there are certain couple of good stocks which are likely to be in the uptrend over coming days. That would be NIIT Tech, Infosys, then Tech Mahindra. We see that after entering the weakening quadrant, it has suddenly reversed its momentum and it's now heading back into the leading quadrant. Along with that, we'll have some good improvement in relative momentum in SCL Technologies here and on the TCS. The rest of the components like Mindtree and OFSS, that is Oracle Financial and Software Services, Wipro, etc., are not likely to put up any spectacular show. So out of this pack, there is one chart that invites my attention is Tata LXI. Though it is seen, drifting lower in the lagging quadrant, but individually speaking, it is likely to show some good momentum over coming week. The one on the left is the Tata LXI chart. It's a weekly chart. And there are a couple of signals that have emerged which show that there might be a potential change in its trend. As evident from the chart, the prices have penetrated above 200-week moving average here, as it is seen inside this circle. And the more important and more fundamental, or rather stronger indication that has emerged is that a very solid bullish divergence over the RSI. It is observed that the stock had been drifting downward and had been, marking levels lower, but during the same 4 months, RSI never made any lower low. In fact, it maintained its bottoms and it's now seen inching higher. So this bullish divergence was an enough evidence which would suggest a possible formation of a bottom in this stock. Going beyond this, it can be seen that the on-balance volume remained sideways while the stock declined. So we can consider this that a lower number of stocks participated in the declines, and in a way it acts as a positive sign whenever we speak about the reversal or the potential reversal, I would say. So that being said, another sector which was worth looking at was energy pack. These are the different components of the energy index plotted on the RRG, and we have used CNX energy as its benchmark. So we see that a couple of stocks are showing either good continued momentum on the upside, and couple of them are seen improving a lot on the momentum front. For example, we have Reliance Industries here in the leading quadrant. We have BPCL in the leading quadrant, but it is drifting lower, and it's likely that it might consolidate at current levels. We have IOC, that is Indian Oil Corporation, moving towards entering the leading quadrant. We have ONGC here, which is showing a sharp improvement in the relative momentum, despite remaining in the lagging quadrant. So again, if we the IT index per se remains in the leading quadrant when it is benchmarked against the broader CNX 500. So among this, if we just try and shortlist a couple of stocks which would be worth keeping an eye on, would be Reliance Industries, ONGC, GAIL, IOC, that is Indian Oil, NTPC, and BPCL. Out of this, there would be one chart which would be worth keeping an eye on from the energy pack would be Reliance. The energy pack remains in a firm uptrend when compared against Nifty 500, and within that, Reliance also remains in the leading quadrant when it is benchmarked against the CNX Energy Index. Now we have Reliance weekly charts on the left-hand side of the screen, and it is quite evident that it is in a very firm secular uptrend. Secular uptrend since 2017. So we expect this stock within this pack to outperform the remaining components. The third sector that I would like to take a favorable view on would be FMCG. Here we go. Here we again see the FMCG components plotted against FMCG index, and here the place is a little crowded here, but still we have a couple of good names that can give us good returns. We see Jubilant Foodworks here remaining in the leading quadrant. We have Imami Limited, which is sharply improving its relative momentum, and perhaps this stock is looking for a major trend reversal. We'll look at this chart as we move ahead. Some good opportunities will be seen in ITC. As seen here, it is again, these are all the components which are looking at improvement in their momentum. We have PGH, that is Procter and Gamble. It remains in the leading quadrant and continues to inch higher while improving its relative momentum. So again, if we try and shortlist a couple of stocks which would be rewarding to keep an eye on in the coming weeks, would be these. ITC, these are not in order of preference. These are just the 5 stocks which I feel are worth watching for in this Nifty FMCG index. They are ITC, Jubilant Foodworks, then we have Godrej Industries, Imami Limited, and Colgate Palmolive India.
That was very, very enlightening, Milan. I actually have a question for you.
Yeah, tell me.
All right. I'm going to go ahead and take the screen. I don't know if you've looked at the comparison between, say, the Nifty 500 index and compared it to the S&P using the correlation.
Right.
But I'm going to go ahead and take the screen and just show you. All right. So at the top of the screen, and this goes back the last 20 years. So this is 2 decades. So we've got the Nifty 500 index here at the top. And then we've got the S&P 500. And you can see that the correlation is pretty strong between the two indexes, that we tend to see positive correlation, but we do occasionally see negative correlation. Now, I'm going to let you think about that for a second, because I want to show you how other indices compare with the S&P 500. I'm going to start with the China Shanghai, because this is, in the news I hear a lot. We always hear a lot about what's going on over in China, But when you look at the correlation between what goes on in the Shanghai composite and what happens in the S&P 500, you really see, not as much positive correlation. I would say it leans toward positive correlation. As you can see, a lot of readings above 0.75, not as many below negative 0.75. But I think when you compare it to some of the other global indexes, you'll see that the correlation between the S&P and what goes on in China is not that great. I'm going to bring up as an example the German DAX, because this one is the one that seems to be most positively correlated with with the S&P 500. Now, we have seen some gyrations the last couple of years, but we've kind of gotten back on track. And so now I'm going to go back to the initial one with the NIFTY 500, because my specific question is, it seems like every time we have a negative correlation between our two indices, we play catch up. One plays catch up with the other. And as I looked back, I didn't really see one always leading the other one. In other words, sometimes it was, the CNX, the NIFTY 500 that was moving higher, and then the S&P would catch up. And then other times it was the S&P leading and the NIFTY 500 would catch up. But my question is, in the fourth quarter of 2018, of course, the U.S. market took that big drop to the downside, easily moving below the lows that we saw earlier in 2018. But the fourth quarter in the NIFTY 500, outside of the initial push back down in October, you didn't really see that. And I'm just wondering, do you have any feelings about, do you think both these markets go up hand in hand? Do you think they're both going to turn lower? Any thoughts?
I have a slightly different view on this. See, if we speak about the correlation of the Indian markets and the US, or for that matter, correlation of Indian markets with any other market, overall, of late, over last couple of months, I have seen that the correlation with most of the markets is not in line with what it used to be in the past. Let me explain. For example, we have been we have enjoyed one of the closest correlation, a stronger positive correlation with the Hong Kong markets. Of late, in the last quarter of 2018, that also has got disturbed to some extent. So sometimes, just like SPY, sometimes it is India who does the catch up. Sometimes it is Hong Kong that plays its part. Same. Now, returning to your question, same thing I have observed with the US market. But see, the thing is that overall, I have observed that we have enjoyed a positive, I would call it a strong positive correlation with the US markets for 60% of the time. I mean, for at least 6.5 to 7 years in every decade, we have been trading in line, in tandem with the US markets. Now, what I feel is that there's some structural things that have taken place in India. I mean, on the Indian charts, on the Indian NIFTY chart, is that it has broken its structural uptrend. Number one, that was sometime, as I just said, in the first week of October 2018. From there on, you see that the equation of the markets being rightly correlated or wrongly correlated, whatever it is, but that equation has slightly, it has got disturbed. Now, my fear is that one thing is sure, that our primary uptrend has been interrupted as of now. And unless we take out the previous highs of 11,700 or 760, it would be, sort of uphill task for the Indian markets to remain in trend. Now, in my opinion, we are in this intermediate trend, secondary trend, I would see, wherein the markets have gotten trendless. They are just since October, they are just oscillating in a broad range. And my another fear is that if they are testing the 10,000 levels again, irrespective of the correlation of the historical correlation that it has enjoyed so far, we are not in for any good development on the charts. So I think this time, I think that Indian markets will need to do the catch up with the Dow, and I see that both the SPX and Nifty, they have been, 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 they are away from their respective lifetime highs, and there are chances that they might, work in tandem with each other when drifting lower is concerned.
Okay. There was one question from the audience, so I want to pass that along to you, and that is, and we have about a minute, so
Yeah.
if you could take a look at the rupee or talk about the rupee, does that present a problem for U.S. investors?
Rupee should not present a problem because, see, basically, if we rupee, it has formed a low at around 73.3 or somewhere around that, and I don't see it being taken out in near future, at least in near next a quarter or two, unless something very drastically goes wrong on the trade talks, so-called fear of the trade talks, or something, very untoward happens on the general election front, and the market goes into spin, or something goes wrong with the Brent crude, because Brent crudes are one of our largest imports. So unless those factors affect negatively, I don't see the Indian rupee taking out the 73.50 levels.
Okay. Fair enough. Well, it has certainly been a pleasure having you on here, Milan, and I hope that you'll come back and join us again real soon.
Yeah, it was my pleasure, Tom. Thank you so much.
Oh, you're very welcome. Very welcome indeed. And there he goes, Milan Vaishnav. And I'm going to just one last time show everybody that if you go into the blogs and go under Analyzing India, you will be able to go back and read some of the work that Milan has done here. It is awesome. If you have interest in the India market, I would strongly suggest that you take a look at his blog article, and it is great to have him on board at Stock Charts. Okay, we are going to move into the 10 in 10. So I know the first request that we had was Ameresco, AMRC. And my producer, Zach, is going to feed me the additional symbols as we go. But I'm going to go ahead and get started here with AMRC. So as we look at this chart, first of all, I pointed out a couple of things. Volume, every time we've had a good move up in the past 6 to 8 months, it's been accompanied by heavy volume. That is a good sign. Unfortunately, when you look out, when we don't have this volume coming in, the volume's been pretty light. I like stocks that are a little bit more liquid. But, the heavy construction industry has not broken out, as you can see. And yet this is a stock that keeps putting in higher highs and higher lows. So the thing I like about the chart is that on a relative basis, relative to its peers, you've got a leader. Relative to the S&P 500, you've got a leader. The problem is that the leadership from heavy construction is only about 2.5 months old, and you want to make sure that that continues. This is a stock that continues to outperform, or had been outperforming even before the group turned higher, but you can see that outperformance was not as great. And if we go back down here, you'll see that more flat. It's really been since this group started to strengthen that we've seen a lot of movement to the upside. AMRC has now risen from about $13.30 to $18 in just a little over 2 months. That's roughly a third. So it's increased its market valuation by about 33% in the past couple of months, which is obviously way ahead of the S&P 500. So I think you've got a good stock here with AMRC, although not a particularly liquid one. I wouldn't say it's illiquid. I would just say it's liquid challenged, if I could use that. Because when you're not into these periods where you've got really strong volume, you can see that the volume many days is substantially below 100,000 shares. And I normally don't like to trade individual stocks like that. So the downside for me is the group. Even though it's starting to strengthen, you want to keep an eye, make sure it continues to outperform, and then the low volume. But the positives in this case, certainly the volume supporting these moves to the upside. This is a stock looks pretty good. And I think they also reported and they missed their earnings, and I think even guided lower, if I'm not mistaken. You want to double check that. But the stock still, even though it's down today, is bouncing back off of the earlier lows. And I think that bodes well for the stock as well. I mean, if it can handle fundamental bad news and still recover off of earlier selling, I think that's a good sign. What else do we have today, Zach?
We have looked at this stock for the past couple of days, but because it was the most popular that was in the chat room, we're going to do it again. It's Tandem Diabetes Care Inc. TNDM.
All right. Well, I looked at this one yesterday, so I said this is a great looking chart. I don't want to spend a whole lot of time. I think you can look at the relative strength going across here. This is what I like to see on charts. So what I'm going to focus on is the fact that this stock came down and hit a key gap support level that I talked about yesterday. I know the stock was trading over 65, and I had mentioned that there was some really good gap support on this heavy volume gap up at around 60. I don't know what the exact number was, but you can see today's earlier low came down to 60.71, and that's where the buyers have started moving into it. So I think overall, this is a nice looking chart. I think that the pullback was an opportunity, still possibly or potentially is an opportunity. I do want to just shorten the chart just to the last couple of months so that we can get a look at as to whether or not it actually did hit that gap support level. So let me just pull that up real quick. Yes, I was a little off on that line. I'll go ahead and change this annotation. We'll drag this up. But that was the gap up on the heavy volume. This is where the buying started. And so when you come back down and you hit that level, which we did, that's where I would expect the buyers to come back in. So far, so good. Now, if it fails to hold, it wouldn't be the first time a stock lost a key support level and still remained in an uptrend. But I do think if it loses this short-term support around 60, then I think that 20-day at 55 comes into play.
All right. Our third stock of the day is Eli Lilly, LLY.
All right, LLY. I'll pull it back up on the relative chart because, as you can see, the pharmas have not broken out, but Eli Lilly has. So you've got a stock that is outperforming its peers, and that shows up here when you look at LLY relative to the pharmas. Also, it's enabled it to outperform the S&P 500, and we're starting to see the pharmas regain some relative strength. I was a little concerned for a couple of months, starting to come back. I would just, the key on this chart for me, because I think Lilly's been a great performer. So I think the key is whether or not pharmas on a relative basis hold on to their recent lows. If they can continue to go along with the S&P 500, or better yet, outperform the S&P 500 and start turning up, then you've got one of the better stocks. And I think the most important thing here, or certainly one of the more important things on this chart, is that volume is unmistakable. Look at the increase in volume as we make this move up. That, to me, tells me there's a lot of accumulation. So if pharmas are strong, Lilly's going to be one of the stocks that I would be most interested in this group. I think it looks good.
All right, our fourth stock, Baidu, B-I-D-U.
All right, Baidu is part of the internet space, and internet stocks are starting to pick up, but I don't think Baidu has really. Yeah, you can see it just continues to trade in this downtrend. Here is the internet stock advance on an absolute basis. Baidu continues to underperform both its peers and the S&P, although here as we begin March, it's starting to show a little strength. It's going to need to do a lot more than that. But internet has actually started to outperform the S&P, and Baidu, part of the group, can't. That ought to tell you something. So this is not a stock that I like in the group, but I do like the group. So what I would say, what you want to look for on Baidu is, number one, an absolute breakout. I think it's pretty clear we had some pretty good support around 176 on the way down. We lost it, volume picked up, and on each attempt to get back through this area, we failed. So I have no interest in Baidu until we get an absolute breakout and begin to show some relative strength. So I would pass for now.
All right, quite a bit of interest in this one. PSA, Public Storage.
Yeah, PSA reported results not that long ago, probably within the last week or maybe two. I think it probably coincided with that volume there in late February. I'm still waiting on a breakout. I think we've got price resistance and gap resistance to deal with. And so that it would give me a little bit of reason to pause here. There is your price resistance from the high that we've seen over the past several months. And then this is your gap resistance. See the gap down on heavy volume? The gap occurred from 217. We gap down to about 211, 212. And you can see the reaction high has been back up to about 214.5. So I think we have a couple of dollars here that we need to get through. And so far, we're failing at the lower number. So I think it's just a little early to get interested in PSA. So I would personally wait until we get that breakout above, say, 217, 217 and a half. In the meantime, I would just look for something else.
Alrighty, our sixth stock is Yeti Holdings. Yeti, YETI.
Yeah, not a whole lot of a history here, but I like what's happening. And just like any other gap up, what I would be doing is maybe taking a look at the gap support. So here was the open, and here was that prior high in terms of candle bodies. It was about 20 and a quarter, and we cleared that on the open, which I think is a good sign. And then that day, we came down as low as maybe 1980 or so. And look at the volume. That was the low. So that means that's where the buyers came back in. So I think on any pullback, and the stock just recently hit 26, I think the 20-day moving average could be an entry point, but I would probably save a little powder for at least $21, the top of gap support. And I would be okay with the stock as long as it continues to trade above that low from that day. And I believe that was earnings related. So I think Yeti looks good, a little overbought, a little extended, but a pullback is one that I would certainly consider on the long side.
Sounds great. All right. Our next one is Walmart, WMT. You know that one. Everybody knows that one.
Yeah, everybody knows Walmart. I actually own this one. I'm playing it off of this 20-day moving average. It hasn't really been doing much. And I think my intraday stop is down below that intraday low from the other day. But Walmart overall has been performing pretty well. I thought maybe it would get a lift with Kohl's and Target coming out the other day, but it really didn't. And so now this is the low that I'm looking at on an intraday basis, because on this move to the upside, this was earnings related. Look at that shooting star. That you're normally not going to get continuing movement to the upside after you post that off of an uptrend, because here you've got a lot of folks jumping in, and then that is kind of like the final push to the upside where you get the last folks in on the short-term basis, and then you frustrate all those that bought between 102 and 104. We're sitting down here at 98. They see other stocks going up, and then they start selling. Well, when they start selling, you got market makers starting to buy, and a lot of times that is when you'll start to see this push back to the upside. So I think Walmart still looks good here. Considering the market's been down, I haven't looked at it recently, but it was down quite a bit when we started the show. I think Walmart's hanging in there on a relative basis and continuing to hold its support level. So I own it, so I can't really say too many bad things about it at this point. I think it's on a relative basis here over the past couple of days. I think it's holding up okay. And I'd like to see it start to turn back up. A move through 100, by the way, I think would start to indicate you're going to go back up to this 104, maybe 106 area.
All righty. The next request is NIO, N-I-O.
All right, NIO. All right, really big move to the upside recently on nice volume, and then a huge gap down today. I did not see. I kind of saw. I remember the ticker flashing across my screen this morning, but I really didn't catch the news. I don't. Maybe it was an offering or something. A lot of times these smaller companies, when they get a big move to the upside, will come out with a secondary offering, and it can really hinder the stock in the near term. If that's the case, it'll probably settle down and start to move back up. But again, I'm not sure about the news on this one. You've got gap support. You can see the big gap up, heavy volume, just about a week and a half ago. We moved up. I would have been expecting maybe a 20-day test, something in the 8.5, 9 area. We actually went a little bit below that today. You can see the volume is heavy. So I'd want to watch this area of support, because if it fails, I really don't see anything until you get down maybe to the 50-day and this price support area from the recent low. This is an uptrend here off of the low in late December. So I don't want to see this prior low violated. I mean, we broke out on heavy volume. So worst case scenario, I think 7.25 is what I'd want to watch.
All right, just two more. The second to last one, our ninth stock is Qualcomm, QCOM.
Yeah, Qualcomm's just been an awful performer. We are seeing some strength today, which is good. Volume's coming back in too, which is good. So maybe it starts to reverse. We do see it outperforming the telecom equipment group finally. We'll see whether or not this lasts, but we are at a relative high over about the last, 5-6 weeks. It's also outperforming the S&P. So what I would be watching, because it is starting to perform better, is let's make sure it stays in an uptrend. So if I'm in this one because it's starting to outperform, there's no reason to lose this 20-day moving average as we pull back. So it's been behaving a little bit better on its absolute chart. I'd also like to see it make it move all the way back up to test key resistance at about 59 and hold that rising 20-day moving average. I do think it's part of a good group. So if it can continue its outperformance versus the group that we're starting to see, Qualcomm could be a really good performer. I haven't really seen too much that I've liked about this until just recently, the last few days. So I think Qualcomm's improving. Again, watch that 20-day, make sure it continues.
All right, and our final stock, I'm not sure if this is a one-word thing or it's Z-scaler. That's the best I'm going to pronounce it. Z-scaler, ZS.
Yeah, it seems to be missing a vowel.
Yeah, I was like, all right, sounds good.
Alex, I'd like to buy a vowel. We need an E. Give me an E. Anyway, I like the stock. I like the gap up. And this is a lot of sideways consolidation. We saw this with Tandem, TNDM, and then we got that big gap up. A lot of times that can signal good things to come. The stock went public, it looks like, back in March of last year, so it's only been around for a year. Not a lot of history, but I do think on a relative basis, you got one of the better stocks in software. Software has been strong, although we've been seeing a little bit of a relative weakness in that group of late. But overall, everything on this chart I like. So as far as annotating, I won't draw the lines to show you the left to right move from, move up left to right across the chart. But what I will show you, very similar to Tandem, when you get this gap up, heavy volume, you pulled back intraday to about 55. This is a stock that got up to about $62 a couple of days ago. And so I think 55, 57, this area is pretty good support. We got down to 57.25 earlier today. So I would not be surprised to see ZS make another run for the 61, 62 area.
All right. And that is our 10 and 10. So Erin has graciously, even though she is moving, we'll still be posting the blogs for all of our slides and whatnot. So if you are a frequent blogger that likes to come on over and read our blogs for market watchers, she'll have those posted for you by the end of the day. So you can go ahead and see all the symbols and all the annotations that Tom just did. So, all right, Tom, I'm out of here. Have fun.
Right. Really appreciate it, Zach. Thanks for subbing. Did a great job. And we will move on. So let's take a look at the market and what is going on. So bear with me 1 second. Looks like we are forging some new lows here. We've got the Dow Jones Industrial Average right now down 160 points. The NASDAQ down 68. If we click on that, you can just see on your screen. Definitely continuing to move to new lows. Now, last week, or actually, no, it was earlier this week when we saw that weakness. Remember, the NASDAQ got down to 7,500 and we bounced. That on a short-term chart, in fact, I think I'll go ahead and pull that up because, you can't really start to see intra period or, an intermediate term downtrend unless we begin to see short-term downtrends. So here is the NASDAQ chart, and you can see first off that over the last 8 to 9 weeks, we have been trading above the 20-day EMA. And the 20-day right now comes in at 74.57 and change. So we've got less than 1% before we come up with a very significant test there. We have not tested it. We got close a couple of times, but we have not tested it yet since breaking above in early 2019. The other thing I wanted to mention is on the hourly chart, because that recent low, and I'm going to annotate this. As I said, you can't really have a breakdown on an intermediate term chart until you see a breakdown on an intraday kind of a chart, a short-term, very short-term chart. So after the gap up we saw on February 25th on the NASDAQ, you can see we pulled back to the 7,500 level, then went to a new high, pulled back again to the 7,500 level. That was on Monday. We rallied back to 7,600, and now here we are again, finding ourselves at 7,500. So each time you go back down, and you beat on that price support level, the better chance you have of potentially breaking below it. So this will be something to watch because the short term in 2019 we haven't really had any situations where the market has had to defend intermediate term support levels. Every time we've gone back to a prior low like here and moved to a new high, we establish a new higher low, and we go to another high, and then we got to establish a new higher low, another high. This would be, you can kind of see this would be a change. And when you look at that hourly PPO turning negative. First time we've seen that over the course of the last month. So there are some negatives, and if we lose this price support, we could see selling pick back up again, and that would take us, in my opinion, down to that 20-day test. Something to at least be thinking about. Okay, I think we can go ahead and move on. We do have one final segment that we want to get into, and that final segment is blog highlights. So there was a poll, or there is a poll that's running, and I really wanted to get a sense of how much you all use the blogs, because it is a great reference area. It's a great tool that Stock Charts has put in place. There are a number of really good authors. I feel privileged to be able to write and do Market Watchers Live alongside of some of the great technicians. I mean, John Murphy, in my mind, is one of the best ever. I learned a lot from John Murphy, and here he is right here at Stock Charts providing some great information. So let's take a look at some of what's going on. I'm going to flip right over to the blog articles area, and let's go ahead and go through some of the things that you might be aware of. Maybe I'll show you something new. First thing I want to start with is Chart Watchers. I really believe if you're not a subscriber to Chart Watchers, you're doing yourself a huge disservice. Not only does John Murphy post in this, which is a free newsletter, comes out every 2 weeks, I think it's a little bit bigger picture than some of the other blogs. Like my blog is a daily blog. So sometimes when I post in Chart Watchers, I try to think about things on a little bit bigger scale. And so, I think that those of you who maybe have a longer term time horizon might find a lot of benefit, a lot of value in looking at the Chart Watchers. But here you are, just sign up, email address, it's free. And you're getting information not only from John Murphy, but a number of others who do provide a lot of their time to try to keep you updated on the market. I would highly recommend this as your number one priority on this page if you haven't already done it. All right, next up on the blog highlights is here on the left-hand side in chronological order, the most recent articles are going to post here. So as soon as a blogger comes out with their latest blog article, you're going to see it here. Now, mine is a daily chart. Don't ignore this chart is a daily blog, I should say. So mine is a daily blog. Don't ignore this chart is daily. And then you'll have some that are members only. You do need to be Stock Charts members to get some of those, including the market message by John Murphy and Arts Charts, Arthur Hill. Some great information there, but you do need to be members to access that. But you can go right down the list. Some of these come out daily. Some of them come out every couple of days. The Stock Charts Chart Watchers newsletter comes out twice a month, first and third Saturdays of the month, typically. So that's your recent blog post. Now, I talked about how you can subscribe to Chart Watchers. Well, if you go into one of the blogs, and of course, I'm going to bring mine up. If you scroll to the bottom of any of the bloggers' article, you will see at the very end a subscription area where you can type in your email address and hit the subscribe button. And by doing so, number one, you're supporting the blogger. I know I can probably speak for all of the bloggers. We really appreciate subscriptions because the ones that are free obviously don't cost you anything, and it does allow us. It's a way of us knowing that our work is appreciated in the things that we do. So again, I think I speak on behalf of all the blog authors. If you would subscribe to our blogs, that would be awesome, because we do take a lot of time to provide you with hopefully some great information to help you manage your financial future. Let's see. Let's talk about popular blog articles. Let's go back. And right here are, over the last couple of days, it will highlight some of the articles that have been read by more viewers. So if you're looking for, okay, which one of these, I only have a limited amount of time, maybe the popular articles area might appeal to you. Featured authors. My goodness, look at this list. Starting off with John Murphy and Martin Pring. I mean, really? These are fathers of technical analysis, so many books written. Again, I feel absolutely privileged that I'm even on this list with some of these technicians. Arthur Hill, and many of these names, as you go down the list, I'm not going to read them all off, but many of these names, including Milan, you just heard from, they come on Market Watchers Live a lot. They provide us some great information. Several have shows of their own now on Stock Charts TV. Arthur Hill, Greg Schnell. I'm probably going to miss some. Carl and Aaron, I know, do their own Decision Point show now, Friday at 5 o'clock. Bruce Fraser is on, does his show. I mean, the list is amazing. So check that out. But in addition to these featured authors, there are also top advisor corner authors. And we have had these guys on our show and gals as well. Tim Ord has been on our show multiple times. Tom McClellan. I mean, we got oscillators named after Tom McClellan. So obviously there are some great guests that we have on here. But you can check out the top advisors corner. Click on their article. They come out periodically. Again, they're sharing their time, their expertise. Check out their articles. And I think what you're going to find when you go through all of these blog articles and you really start to learn what each author is all about, you're going to find some authors that appeal much more closely to your trading style. I know I get a lot of comments on Market Watchers Live that we should focus more on long-term because I tend to be much more of a short-term oriented trader. I do look at long-term, big picture view, but I know that I tend to focus much more on the short term. So my blog might not appeal to those of you who are more long-term, but those of you who are short-term, it will. Now, if you look at Decision Point, which I think is more geared to intermediate to longer term, then I think you have a much different blog article and blog authors that will help and that will appeal to maybe your strategy a little bit more. So there's a lot of different strategies. There's a lot of different styles. And hopefully, as you go through these blogs, you will see something that's really appealing to you. One last thing that I wanted to mention, too, here is the public chart lists. And here are fellow members at Stock Charts who, again, give their time and a lot of the charts. You can also, as a member, you can have a public chart list your own, that you put out there to the public. But Joanne Klein, who's been doing this for a long time, has a huge following. And you can see as you go through, she's got a description on her style and strategy. And if you like it, you can go through and look at these charts. I mean, there's so many different ways that you can, different styles and the way you annotate them and so forth. You're going to see a tremendous variation as you go through the public chart list. So literally, there's so much value in the blog article area that I hope you're getting, that I hope you're using it and using it enough to really get some great information out of. I do want to focus just for a couple minutes here on the Chart Watchers newsletter because this comes out again every couple weeks. And I think, I don't know, maybe it's just me, but when I look at it, I think that you're getting some really good big picture articles from some really well-known authors. Greg Schnell, who comes on the show, many of you may know him as the Canadian technician. I know him as one of my really dear friends. Greg does a great job, and his article was focusing on what was going on in China. So talk about big picture, looking at different markets around the globe. Greg zeroed in on the China market, went through, showed you looking at some of the ETFs. So you don't have to be an expert in China to invest there. You've got somebody like Greg looking out for you, pointing out some of the things that are really moving in China. You go down the list. I was looking at gold. I firmly believe that gold's got some issues. And we look at the absolute chart on gold, long term, from 2000 to 2010. Gold was doing great. Relative to the S&P, it was doing great. The dollar was downtrending. But when you look at what's going on now, what we have is our 10-year Treasury yield wildly outperforming the German 10-year Treasury yield over the last 10 years. And that has been a recipe for a stronger dollar environment. And we can see that the dollar, unlike what we saw in 2000 to 2010, the dollar is much stronger now. And as a result, gold, even though it's kind of been going flat for a while, and you might look at it and say, well, yeah, it's been up the last few months. Look at the relative performance. Gold relative to the S&P topped back in 2011. And I would challenge anyone who says that gold is in an uptrend. I don't believe it. I think on an absolute basis, yes, it was short-term trending higher, but on a relative basis, it continues to go down. And in my opinion, it's because the dollar continues to be in this uptrend. So, these are the kinds of articles that you're going to get. Of course, you're always going to get, and of course, Julius does the RRG, which I think is amazing. Arthur Hill, Aaron, John Murphy. Look at this great article from one of the fathers of technical analysis. I could go on and on and on, but this, I just want to say, is the most important thing to do in the blog area. If you haven't already, subscribe to Chart Watchers. Get this information for free and let us help you. Okay, let's bring up the summary slide, things we just talked about here on the blog highlights. I hope that maybe for some of you is just a refresher, but I really hope that you get the most you can out of the blog highlights, this summary that I did, and just in general out of the blog articles, because I know that's one of the visions of stock charts. In addition to providing you great tools and education, it's also about commentary. And so the commentary is there. All you got to do is know where it is and just be willing to go in and use it. All right, let's go ahead and pull that poll up, and we'll go ahead and wrap the show up with that. I really wanted to see what everyone does. That's awesome. Over half of you using it daily. I think that's great. I hope after today that number will jump to maybe 60, 70, 80% of you that use it daily, because there's so much information. Like I said, my blog is daily, but there are so many articles that are just continually feeding through here, and it's all based on technical analysis. And I know that's why most of you are here, because of technical analysis. You believe in technical analysis like me, like all of us authors here. And I think you'll get a lot of great information if you come in and look at it daily. 25% of you use it 5 times or a few times a week. So between daily and a few times a week, we're up to about 4/5 of the audience, which I think is awesome. 2% never used it. I hope after today, this number goes to 0%. I hope you find some nuggets in here that will help in your trading as we go forward. All right, let's go ahead and wrap things up. I can give you the final market update because we are having a rough day today so far, especially the Russell 2000. I'm going to show you this analysis. Look at the percentage. This has been going on recently here the last few days. And I spoke to Greg Schnell just a couple of days ago, and he said this was one of his biggest concerns, is that the Russell 2000 starting to turn back over again relative to the S&P. It's starting to roll over and move lower. And you can see today having a rough day here, down 1.71%, much worse than the other indices. So anyhow, we got upcoming schedule. Always got a lot going on here at Stock Charts and with Market Watchers Live. Looking forward to seeing Bruce Frazier tomorrow. He's going to co-host with me. So that'll be great for all of you Y Coffeeans. And then you can see some other great information as well. I want to thank all of you for being with us today. Please remember to complete the survey as you exit. It's located below your video player. We always love to get your feedback. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. We'll see you back here tomorrow. Happy trading.